Hey everybody, David Chang here, founder of The Art of Thinking Smart, and glad you can join me on this video series of long-term care. And in the subsequent videos, I talked about how long-term care is something that is becoming a bigger deal for a lot of families as we're living older. I talked about what long-term care is, the different options you have, how much it costs, and how you could fund it. And so in the last one, I just talked about the three main types. And this is part two, because I want to now go a little bit more in depth on strategies that you can employ to maximize your dollars. And I talked about how self-funding, $135,000 a year goes very, very quickly. And even if you want to save for it now, you have to save a lot of money for how expensive long-term care is. And this video here, I'm going to briefly talk about three types of funding. In 2010, the Pension Protection Act was implemented, and this really opened up a new approach to long-term care, and I'm going to be talking about it because a lot of people don't know about this. And then lastly, I'm going to close with long-term care, the funding strategies, because if you use these strategies, you could stretch that dollar out, because we want to make sure we're planning ahead. Now, we talked about in the last slide that you have existing assets. In the last video, you could self-fund, but the problem with self-funding is you're assuming all the risk. And if you end up needing long-term care for a long period of time, you may run out of money, or you may have nothing to leave to your children or grandchildren. Some people say, nah, I don't want to do that. You may qualify for government funding, where we talked about Medicaid, Medicare, the Veterans, and the Old Americans Act. And we talked about how, unfortunately, some of the types of care are not funded by these programs, and those that are, you have to have certain qualifications. You have to draw down your money, in some cases to only $2,000 in assets. Then you qualify for Medicaid. We talked about private options, private financing options, where you can purchase long-term care insurance, and you could use your home equity, reverse mortgages, certain types of annuities, life insurance, and trust. And I briefly talked about long-term care insurance. A lot of these products here that people use, they tend to be more illiquid. Illiquid meaning it's not like a regular investment where you're going to invest in it and you're going to change your mind a couple months down the line and say, I want it back. You can't, which is why I always make sure that people understand all the options, because some of these things may be good for you, some may not be. And I highly suggest you talk to a financial professional. You could even talk to one of my advisors at wealthbridgeinc.com, and they'll just go ahead and give you just a free consultation so you know your options. Because the biggest thing is that you don't want some sales professional trying to ram down a product down your throat that may not be good for you. So I always suggest do your research and homework, figure out what is the best option for you. Now, I'm going to talk about a little bit about this new approach. So we've had our traditional approach of long-term care insurance and the different options we talked about. And when the Pension Protection Act was passed, what it essentially did is it gave companies the ability and people to really have life insurance and use some of the life insurance for long-term care or cash value or even annuities and have a long-term care component with it. And so what it did is that if you used the policies with annuities or life insurance for long-term care, you got some tax benefits, tax advantages from that. Beforehand, if you had life insurance and you took out cash value or accelerate death benefit, sometimes parts of it were taxable, and so it didn't make sense to do that. But with the passage of this act, it opened up to where these hybrid products were created. And some of these hybrid products, I think, can be very beneficial for some people. It's not for everybody, but if it is for you, it has a lot of advantages. Where traditional long-term care, it was use it or lose it. I'm going to pay per month, and if I don't use it, oh well, the insurance company won out. These products instead of renting the policy like traditional long-term care, you own it. Whether you use it or not, you could use it for something else. So I just use example of life insurance. You buy this policy. If you don't use it for long-term, okay, so it's a life insurance death benefit, and instead it says, well, I need long-term care. You can use that life insurance benefit for long-term care, or you can even have, in some cases, cash value. So it's a guaranteed minimum cash growth that you have. And if you don't use it for long-term care, you can have the cash for it, or you can go ahead and use it for the death benefit. So I'll give you a basic example for this, and this is for hypothetical and illustration educational purposes, so I just want to be using this as an example. So please don't say, okay, well, you know what, David in this video said this. This is just kind of one illustration that's very similar to a recent kind of quote that I did. And so let's just say we have someone age 65, they got good health, and in this illustration we just say 4% cash accumulation minus the life insurance is guaranteed. And they've saved up $150,000 and they're at the age of 65. If they choose to purchase this type of hybrid product, what they're doing is they're leveraging it, and that $150,000 now has become $300,000, right? You just doubled your money, which is great. And at death, and one of the options there, so let's just say 15 years later, so 65 at age 80, if this person passes away, they'll get the death benefit to the beneficiaries, tax-free. So they doubled their money, they got $300,000, that's great. Let's just say at age 80, they're thinking, you know what, forget it. I don't want the life insurance or the long-term care. I just want to take the money and go on this worldwide cruise, and that's fine with me. At year 15, in this example that I said, some policies have it, well, they'll get $180,000 back out. So they put $150 in, they got $180 back out. Not bad, especially since the cost of holding that money for 15 years, you could have used it for the death benefit or long-term care. So let's just say, okay, we have three options. You could use it for the tax-free death, you can use it to if you're going to quit or surrender the policy, or you could use this for long-term care. And so for this example, let's just say, all right, this company will pay out for 60 months, right, $5,000 per month. So that's pretty much, you took $150,000, you're able to use it for long-term care, you just doubled it. So instead of self-funding at $150,000, you just were able to leverage it. The way we kind of look at it is you took money from your right pocket, put it into your left, and just doubled it. And you get to have three different options with it, which is pretty good. And on top of it, some have what we call riders. Optional lifetime riders that in this case, if they paid an extra $1,500 a year, what it is even if this $300,000 runs out, it'll still pay out the $5,000 per month, which is great. And some policies have it where it even is pegged to inflation. So if you end up living to 100 plus, guess what? You really won out if you got the optional long-term rider. And even if you didn't end up using it, you still had the three different options that you had. So this is one of the benefits for the hybrid. And again, it's got to be right for you. But I think that because there's a lot of flexibility with it, and if people they want to prepare for long-term care, this is something that people should look into. I'm going to talk about funding strategies, and this is kind of just where it's going to be something where you want to sit down with you and your loved ones and figure out, okay, what is it that we want to do? And here's why. The Medicaid drawdown, if you're going to say, I only have an X amount of dollars, and you know what, instead of trying to self-fund, instead of buying the long-term care insurance or anything like that, I'm just going to go ahead and give it away to people. But here's a problem. Medicaid, the government, they used to only have a 3-year look back, now it's 5 years. So if you apply for Medicaid and they saw that within the previous 5 years you gave your money away or you gave a house away without getting a market rate in return for that, you don't qualify for Medicaid because they're going to say you broke the law because you should have known that you have to draw it down. You can't just give it away to loved ones. So the government has that in there. Something that people can do, again, the issue here is that if you draw down, you may not have anything for your family or spouse. That's why I talk about that Medicaid is something that if you don't have any assets, it works out. But for the middle class, unfortunately, they get kind of hurt the most when it comes to this. So how do we plan for this Medicaid? And there's two things we could do. One is depending on the state you're in and you want to see an attorney, our staff, we have an attorney that's helping out with people, is you can create a trust, let's say an irrevocable trust, and you transfer the assets in there. Now the trust owns the assets, you don't. So you may qualify for Medicaid. And again, you have to work with an attorney to make sure this is done in a legal and right way. Another thing that's out there are these compliant annuity products. And what it is let's just say that you have $300,000, you need long-term care, and you realize, wow, I'm going to draw this down in 2 years, but my wife, she needs that $300,000 to live off of. I can't give it to her because there's that drawdown, and there's a problem is that, well, what happens if I use it? How is she going to live? So these types of annuities, what it does is that it automatically is exclusive, right? Excluded from Medicaid. Medicaid counting this as assets, gives immediate income to your spouse, and what's it called, you or whoever is the policyholder gets to qualify for Medicaid. So you get to really take a couple, 300,000, I think 1 million in most cases the maximum, that you could put it in a product that pays out your loved ones and someone can go into Medicaid. And so here's kind of briefly just showing how it goes. We talked about self-funding. We talked about the different types of the hybrid here, where the tax-free death benefit, accumulate cash, and then available long-term care benefits. If they're going to draw it down, instead of drawing it down, they could purchase a qualified Medicare product. And what they do is they take the assets, they move it over to this product. The policyholder can go to get the Medicaid benefits, and the spouse or the loved one can get the income. So that's one good strategy to use. And that's why I'm very big into looking at the whole wealth and health. And I'll talk about how this new company, Home Care Solutions, combined with Wealth Bridge, has created Care for Life package by being able to combine the benefits of both the wealth side and planning for it, and because they've got top-notch quality care, they'll be able to combine and give the benefit goes to the clients. I'm going to end on a couple other funding strategies to talk about, and you can get more details on my site, artofthinkingsmart.com/care. Sometimes you don't have to say, I'm going to either self-fund it all or I'm going to buy insurance and have that funded. You can do a combination. You could say, I'm going to buy enough long-term care to maybe fund $150 a day, and the other $150, if I need to go to a nursing home, I'm going to self-fund it. So that's one option, and you want to see what is the rate, your burn rate, right? How long will it be that your long-term care product with your self-funding, how long will it last? So this is what you want to sit down with your family to figure out. This is something that is even for my wealth management clients I talk about is, what order of funding? And here's what I mean, is that if you have a long-term care policy, you have a brokerage account, and let's say you have a Roth IRA. You don't want to take from your Roth IRA first, right? You want to make sure that we're going to liquidate, we're going to use up all the insurance. If we still need it, we go to taxable accounts. If we still need it, then we go to your Roth IRAs. And the reason is that the Roth IRA grows tax-free, so it's compound interest. So the longer you can hold out from drawing down on that account, the more money you're going to make because Uncle Sam can't touch it. Whereas Uncle Sam is touching at least a taxable portion. So this is something that you want to be with a financial professional, part of the comprehensive financial planning process of creating a funding order plan. And this is same principle goes for drawing down for retirement, right? Because you want to make sure that you maximize your dollars. A couple other things, make sure you have an estate plan in place. Medical directives, power of attorney, trusts, and wills. The reason you want to do this is this helps protect your funds. One thing about medical directives, some people just say, you know, if I get sick in an accident or something like that, there's a certain quality of life that I want. If I'm not going to get it and you're feeding me through a tube, go ahead and pull the plug. And that's what a medical directive does. Because if people don't have a medical directive, you know, your family members want you to stay alive as possible because if there's a small chance you may come back. But that last few years could be very, very expensive. If it's something that you said, hey, if I'm going to be a vegetable, just go ahead and pull the plug. But if they don't and you're in there for 2 to 3 years and they draw down all your assets. So this is something that you want to work with an estate planner. You want to be able to talk to your family about and make sure everything is set up that your decisions are kept, that they respect what you want, not what someone else wants. I also talk about this, and I'm going to end on this one on the plans and agreements portion. A lot of times when a family member needs it, it's usually the closest relative. Maybe let's just say mom, dad gets sick. It's the closest son or daughter that has to take care of it. And I've been in many cases where you'll have siblings all across the country, and people across the country, siblings will be the Monday morning quarterback saying, oh, this and that. But the caregiver themselves are going through the stress, the extra time, resources, loss of income. And it creates some animosity between siblings because they're fighting, saying, hey, it's not fair that everything is split because I did all the care. So I suggest that before you even need care, go ahead and designate a caregiver. And instead of just saying, okay, you're a caregiver, thanks for doing so, come to an employment agreement. If you become a caregiver, you'll get X amount of dollars per month from our funds or for long-term care insurance if it works out. Or if that's not going to happen, update the estate plan so that the person taking care of it feels compensated for the care that they gave. So I think that's something that you want to really talk about. And if you do an agreement or an estate plan, share it with everybody, because I've seen cases where family members accuse others of kind of insinuating like manipulation. You know what? You don't want that to happen. Downsizing plan is one thing. If you're going to downsize, go to assisted living, nursing home, what do you do with your stuff? What are you going to do with your car, your personal property, your house? Are you going to sell it? So have a plan, because you don't want family members fighting over it. Or maybe if you needed short-term, long-term care and you are now healthy again, you realize, whoa, what happened? So having a plan is very important to make sure that your decisions are respected and you maximize the resources that you have. So thanks so much. This is the long-term care series, and come back to this because I'll be continually updating this. And my goal is to really give you all of the basic information that you need to give you the education that you feel more confident of the decisions you make, the planning that you do, what long-term care is, how much it costs, and the best ways to fund it. You can go to artofthinkysmart.com/care for more information. Thanks so much, and aloha.